Hi there, this is Chris from MoneyHub, and this video looks at home renovation loan repayment calculators. So it's very common for people to do up their house and get a loan to do that. There's two ways you can get that loan. You can go directly to a bank and put that on your mortgage. Alternatively, you can go for a fixed term kind of personal loan, but it'll be under the umbrella of a home renovation loan. Then you pay that off in a much shorter time. What I'm going to do is show you how this calculator works so you can compare both options and work out the overall cost. So first up, there's three inputs. This one won't really change because usually it's going to be a principal and interest that you repay, which means that when you take out a loan, it's going to be repaid, at the same time that you repay the interest. It's not going to be an interest only, which is the alternative. So that's the standard setting. And then I'm going to say if we needed to do a renovation for $100,000 and we've decided to take out a 5-year loan on that, and the interest rate we can get, and it's secured against a house, but it's with another asset, it's with another lender, not the mortgage, so not the home loan, then we can see that the overall cost is going to be $42,000 for the interest over 5 years. If we pay it weekly, it's going to be slightly less. It's going to be $42,282, but you can see that the repayments are roughly, if I just go on to monthly again, $2,400 per month. Now, if I compare this to taking out $100,000 on a mortgage, then we'll be able to see what the interest cost will be overall. So with the new calculator, let's put in that $100,000 again, and then let's put the loan length term as 15 years. So that's going to assume that you've already perhaps had 10 years on it, but of course you can change that, and then let's change it to an interest rate of say 6.5%, which is kind of standard for a mortgage, but of course they are going up. So why don't I just make that slightly higher and put it like at 8%. So what we can see here is that the total cost of the interest is going to be $72,000 over that 15 years, whereas the short-term loan is going to be $42,000. So you're paying off, an extra $30,000 for the same amount of money. And the reason is you're paying it off, over a longer period of time. If you were then to say, okay, well, I've got 10 years left on my mortgage, let's redo it at that, then once again, the interest is going to drop. It's going to be roughly the same as a personal loan for a home renovation, but it's still going to be slightly more expensive. Of course, what drives this is the interest rate and the term for both loans. So if you did have an interest rate which was quite high, say 20%, and then your term was 3 years, then that's probably going to be lowering it because the term is shorter. Yes, but so these are all comparisons that you need to make. So what I suggest is just refresh our guide, click on the calculator down below and start comparing sort of apples with apples. Look at the options there so you can make an informed decision. But usually it's not so great to have external debt to your home. I mean, I understand we're not very pro personal loans unless they're an absolute need. But in this case, there is some, financial evidence, for example, being the numbers, that it can be cheaper to take the loan, secure it if that's something that you want to do, or keep it like an unsecured loan, and simply go through the process of working out what's more cost effective. You will have to manage another loan if you take out a separate loan to your mortgage, but at the same time, it won't drag out as long as your mortgage. If you've got 20 years left, if you've got 25 years, for example, then, a short-term home renovation loan can be much more sort of financially beneficial. So that's the summary of how to use it. Usually, from what we've seen, that home renovation loans max out around $50,000. That's not always the case. So I've put $100,000 there, given, the cost of materials and the fact that if it is secured against a property, then, and there's equity in that property, then, lenders are more willing to lend on it. If you have a home loan, then what you need to do is ask about a top up, and that will be applied at the current mortgage rate. Bearing in mind that if you do roll off that mortgage rate, and then there's a new home loan rate for the next term, that could be higher or that could be lower than what you're currently paying. And if you've drawn down on the home loan or topped up using to pay for the home renovation, then that's going to affect how much you repay overall. So please let us know if you have any questions in the comments below, because we have lots of guides coming out on this. We're always updating. We just want to make sure that the guides are as comprehensive as possible. So we really appreciate it when people do ask questions, because we can enhance it, like if things aren't clear. Whenever someone does ask, I always answer. So please do. And thanks very much for watching.